Before I get into today's numbers, I want to be completely transparent with you and with the platform about what this channel is and what it is not. Everything you're about to hear is sourced directly from publicly available exchange data, published vault reports, institutional analyst statements, and CME Group official filings. Every number in every video on this channel has a verifiable primary source. We do not make financial recommendations. We do not tell you to buy or sell anything. We present raw market data and explain the mechanics behind it. If you're a viewer who has been directed to this channel, you should know that we exist for one purpose: to give you access to the same data that institutional traders review every morning, explained clearly without spin, without a product to sell you, and without an agenda beyond accuracy. If you find this channel valuable, the single most important thing you can do right now is subscribe and hit the notification bell. Every subscriber who does that becomes part of the record that this channel serves a genuine informational purpose. This is not a conspiracy channel. This is a data channel, and today the data is telling a story that is genuinely important to understand. Let us get into it. Silver is trading around $84 per ounce as of this recording, down from the $90 intraday high we hit 2 days ago on Tuesday. Gold is around $5,110, down from the $5,219 peak earlier this week. The gold to silver ratio is at 59.6 to 1. The market has pulled back. This is not surprising. What is surprising, and what I want to spend this entire video explaining, is why that pullback is being engineered, who benefits from keeping silver below $90, and what the data from today's depository report tells you about whether that defense is working or whether it is slowly failing. Let me start with today's depository report, because there's a single headline that sounds bullish and would fool you if you stopped reading after the first line. For the first time in weeks, physical silver came into the COMEX system rather than out of it. 2 vaults received metal. CNT took in approximately 599,000 ounces into eligible. StoneX received approximately 259,000 ounces directly into registered, the deliverable category. Total inflow, roughly 858,000 ounces. New metal inside the exchange, the first time we can say that in a very long time. Now, do not close the video thinking the crisis is over, because on the same day that those 2 vaults received silver, 1 vault, MTB, Manfra, Tordella, and Brooks withdrew over 1,058,000 ounces from eligible, gone, not reclassified, physically removed from the vault. The metal left the building, and HSBC pulled another 16,000 ounces out on top of that. So you have 858,000 ounces in and over 1,074,000 ounces out. The inflow was real. The outflow was larger. The combined COMEX vault has now lost nearly 5 million ounces in 2 days alone. The withdrawals outpaced the inflows by more than 8 to 1 on a weight basis. Here's where the total stands as of today's report. Combined vault at 324,123 ounces. Registered specifically, the silver that can actually be used to honor a futures delivery notice at 78,610,868 ounces. Compare that to the peak combined vault of 533 million ounces in early 2026, when tariff fears drove silver into New York from around the world. In roughly 3 months, the COMEX system has shed nearly 190 million ounces, and the registered pool that matters most for delivery season is sitting at 78.6 million ounces, with May open interest still above 380 million ounces of paper silver. This brings me to the central question of today's script. Why is silver at $85 right now? Not 89, not 92, 85. The physical data says the vault is draining. Shanghai is paying a significant premium above COMEX. The structural deficit in the silver market is in its 7th year, yet here we are at $85, 2 days after touching 90. I want to be precise about what I am and am not claiming here, because this channel operates on verified data and institutional analysis, not on assertion. What I am describing is observable market behavior with a specific mechanical explanation. What I am describing is not a claim about individuals making decisions in coordination. It is a description of institutional incentives that create predictable behavior at specific price levels. The $90 level in silver is what markets call a technically significant resistance zone. When a commodity or asset approaches a round number that it has failed to break through in recent history, paper market participants at every scale, from algorithmic trading systems to manual proprietary desks, have sell orders staged near that level. This is not secret or conspiratorial. It is the standard mechanics of technical resistance. Every trader who bought silver near $80 and saw it run to 90 has a profit to take. Every trader who is short and has been waiting for a price to add to their position enters new short exposure near 90. The concentrated selling pressure at 90 is real and is predictable precisely because the price tried to clear 90 twice in recent weeks and failed both times. The first failure was at $90.38 on Tuesday. The slam to $87.25 that followed was the paper market executing on pre-positioned sell orders at that resistance zone. But there is a deeper institutional dimension that goes beyond normal technical resistance. The COMEX is a paper market. Its participants include large financial institutions whose balance sheets have exposure to silver on both sides. The registered vault stands at 78,610,168 ounces as of today's report. The May open interest will approach first notice day on April 30th, with somewhere between 350 and 390 million ounces of paper silver outstanding. Every dollar that silver rises between now and April 30th makes the liability side of the short book more expensive to manage. Institutions with large short positions have a direct financial incentive to prevent silver from establishing a sustained floor above $90, because a confirmed floor above 90 makes the arithmetic of May delivery exponentially harder to manage. If the market believes 90 is a permanent floor, more physical buyers will stand for delivery at 100, 110, or whatever price they believe settlement will clear at. The defense of the $85 to $89 range is not noise. It is a rational financial decision by participants who understand what May's open interest looks like against what the registered vault contains. Now, I want to tell you why that defense will not succeed over the medium term, and I want to do it with specific numbers and a specific timeline rather than vague, bullish language. The inflow we saw today at CNT and StoneX is the first piece of evidence in weeks that the system is attempting to replenish registered inventory. StoneX received 258,738 ounces into registered. CNT received 598,969 ounces into eligible. Combined inflow across those two vaults was 857,707 ounces. That sounds meaningful until you compare it to the pace of ongoing withdrawals. MTB alone withdrew 58,679 ounces from eligible on the same day. HSBC withdrew 16,006 ounces from eligible. The net change in eligible was negative 475,722 ounces. The net change in the combined vault was negative 216,972 ounces on the activity day, plus continued decay across the week. What the inflow tells you is that somebody, probably a refiner or a miner or an institutional party holding refined silver elsewhere, made a decision to deposit metal into the COMEX system on this specific day. Why would they do that? Two possible reasons. The first is arbitrage. If the COMEX forward price for near-term delivery is attractive relative to the cost of holding silver elsewhere, a holder of refined silver will deposit it into a COMEX vault and sell futures against it to lock in the spread. The second reason is more structurally interesting. If a large commercial buyer, an industrial user like a solar panel manufacturer, or an electronics producer needs to access COMEX registered silver to satisfy a delivery obligation or procurement contract, and that buyer is willing to pay a premium to a silver holder outside the COMEX system to bring metal in, the deposit happens. Either way, someone decided the economics of putting silver into the COMEX system were attractive at current price levels. The fact that it happened at all is a data point. The fact that it was overwhelmed by withdrawals on the same day is the more important data point. Let me now walk you through the price floor scenario in the way I have been thinking about it, because I think this is the most useful framing for understanding what is likely to happen over the next 6 to 10 weeks. Silver is currently at approximately $85. The $90 level is the first major technical resistance. Here is the sequence of events that the data is building toward with approximate timelines. Between now and approximately March 27th, the remaining March delivery contracts will clear. There are approximately 1,281 contracts still open in March, representing 6,405,000 ounces. As those deliveries complete, the registered vault, which is currently at 78,610,868 ounces, will absorb those delivery notices. Some of those delivered ounces will stay in vault, some will be withdrawn immediately. Based on the pattern of this entire delivery cycle, where January and February delivery recipients withdrew metal at historically elevated rates, I expect continued net withdrawal pressure through March close. The registered vault will likely be in the range of 70 to 75 million ounces by the time the March contract fully expires. That 70 to 75 million ounce registered number is the context for what happens next. April is not a major delivery month, it is a minor contract. April open interest is currently sitting at 1,235 contracts, which is 6,675,000 ounces. April deliveries will be small and will not materially stress the registered vault, but April is not irrelevant because it is the last month before May 1st notice day on April 30th. Every day in April is a day in which the registered vault continues its baseline drain from ongoing withdrawals by physical holders who want their metal out of the exchange system. At the current combined vault drain rate of approximately 2 to 3 million ounces per day, April will add another 40 to 60 million ounces of combined vault outflow. The registered number within that total matters most. If registered drains at even a fraction of that rate, the post-April registered vault could be in a range of 60 to 70 million ounces when May 1st notice day arrives. May open interest is currently at approximately 76,948 contracts, 384,740,000 ounces of paper silver against a registered vault that will likely be between 60 and 72 million ounces. The paper-to-registered ratio at May 1st notice day under current trajectories will be between 5.3 and 6.4 to 1. Here is what that ratio means for the price floor thesis. In previous delivery months this cycle, the COMEX has used EFP cash premiums to encourage large, long position holders to roll their contracts to London rather than stand for physical delivery. That mechanism has worked. It is why we have not seen a formal delivery default despite the ratio deteriorating for months. But the cost of the EFP premium required to persuade a holder to roll rather than stand increases, as the registered vault gets smaller and the Shanghai premium stays large. With Shanghai at approximately $100 and COMEX at $85, a long position holder standing for May delivery is looking at a $15 per ounce incentive to take physical and either ship it east or hold it against the structural shortage. For the EFP to persuade that holder to roll to London instead of standing, the cash premium has to be competitive with that $15 arbitrage incentive, plus the holder's forward view on price. At 60 to 70 million registered versus 384 million paper, the cost of buying peace on May becomes enormous. This is the mechanism through which the price floor forms. It does not happen in a single day. It is a negotiation between the paper market's defensive capability and the physical market's structural demand. The price sequence I expect based on the data available today is approximately as follows. In the remainder of March, silver consolidates in the $83 to $89 range. The $90 level continues to act as resistance that gets tested repeatedly and repeatedly defended by concentrated paper selling. Each test is a battle. Each failed test at 90 reinforces the perception that 90 is impassable. The mainstream financial media describes the range-bound action as silver running out of momentum. This narrative is false, but it is reinforced by every short-term failure to hold above 90. In April, as April 1st notice day approaches and the May up open interest begins to receive attention from institutional risk managers, the cost of defending the 85 to 89 range begins to rise. Each EFP payment to a holder rolling out of May costs real money. The physical drain continues. The registered vault compresses towards 60 to 70 million ounces. A small number of large, long position holders in May begin to signal through the EFP spread widening and through futures curve behavior that they are not going to roll. They are going to stand for delivery. The May EFP begins to trade at a significant positive spread, reflecting the premium the paper market is willing to pay to avoid delivery. In the last 2 weeks of April and the first week of May, as first notice day approaches on April 30th, the price volatility increases dramatically. The defense of the paper market's chosen range becomes increasingly expensive and increasingly visible. Silver tests 90 again. This time the defense is weaker because the registered vault has less ammunition and the EFP cost is higher. Silver breaks through 90 and spends time above it. The mainstream media calls it a breakout and attributes it to a news event, a Fed statement, an oil price move, a geopolitical development. The real driver is the registered vault compression and the May delivery math. Once silver establishes a genuine floor above 90, meaning it tests 90 from above rather than below, the psychology of the market shifts. The shorts who have been defending 90 need to cover or face accelerating losses. The physical buyers who have been patient see the defense failing and accelerate their demand. The Shanghai premium either compresses somewhat as Eastern buyers get some of the metal they need, or it stays wide and continues to provide a bid floor. The price moves toward 95. At 95, the same dynamic repeats at a smaller scale. Technical resistance, paper selling, range consolidation, and then a test that the defense cannot hold. The registered vault at that point is in the 50 to 65 million range if the drain continues. A May delivery conclusion that processes 20% of open interest, which is 76.9 million ounces, exceeds the remaining registered vault by any estimate. The exchange either finds inbound metal, runs emergency eligible to registered conversions, or pays whatever EFP is required to hold the remaining longs. The cost of that operation at 95 is higher than at 90. The cost at 100 is higher still. This is not a prediction that silver goes to $100 on a specific day. It is a description of the mechanical sequence that the vault data is pointing toward. The timeline is approximately 6 to 10 weeks from today, with the critical inflection point being the 2 weeks around May 1st notice day on April 30th. The sequence of floors is 90, then 95, and then the question of whether 100 holds or becomes the new floor in turn. What would accelerate this timeline? A geopolitical escalation that brings more institutional safe haven buying into silver. A Fed statement that shifts rate expectations hawkish and weakens risk appetite, paradoxically bullish for hard assets during a stagflation context. A large industrial buyer announcing a strategic stockpiling program that creates visible physical demand outside the futures delivery system. A disclosure that a major eligible silver holder at a COMEX vault has decided not to convert to registered, reducing the pool of potential conversion candidates below current assumptions. What would delay or disrupt this timeline? A major COMEX rule change before May 1st notice day, similar to the Silver Rule 7 of 1980, imposing position limits or cash settlement requirements that prevent large holders from standing for delivery. An emergency inbound silver shipment from a non-public source, such as a government strategic reserve sale that temporarily replenishes the registered pool. A dramatic Shanghai price collapse that eliminates the arbitrage incentive for eastward metal flow, which would require either a massive increase in Chinese silver supply or collapse in Chinese industrial demand, neither of which the current data supports. Now let me address the 1980 parallel directly, because I keep seeing it misused in both directions in silver commentary, and I want to put the historical record straight. In January 1980, the Hunt brothers of Texas had accumulated a position of approximately 100 million ounces of physical silver and a comparable amount in futures contracts. The COMEX silver price reached $50.50 per ounce on January 18, 1980. At that price, the Hunt's position was worth approximately $10 billion on paper, which at the time represented one of the largest individual commodity positions in history relative to the size of the market. The COMEX exchange responded on January 7, 1980, before the peak, by implementing what was called Silver Rule 7. That rule changed the position limit mechanics and effectively banned new long purchases of COMEX silver futures, allowing only liquidation trades. The exchange was not a neutral market operator in 1980. It took an active intervention to break a squeeze that was developing against a market where the Hunts and their allies controlled an estimated 1/3 to 1/2 of the world's above-ground silver supply. I want to be exact about what that intervention did and did not do. Silver Rule 7 did not resolve the underlying scarcity. It prevented new long buying from amplifying the price, forcing the market into a one-way liquidation mode. The price collapsed from $50 to under $11 by March 27, 1980, in part because the Hunts were forced to sell into a market where only sellers were allowed to operate. The intervention was a rule change that broke the specific market position driving the squeeze, not a fundamental resolution of silver's underlying supply dynamics. The current situation has a structural difference from 1980 that makes the Silver Rule 7 playbook harder to apply today. In 1980, the squeeze was driven by a single identifiable speculative position, the Hunts. The regulatory and exchange response could be directed at that specific position because it was concentrated, identifiable, and on one side of the trade. Today, the long side of the COMEX silver market is distributed across thousands of individual holders, institutional funds, industrial users with procurement obligations, and sovereign entities. There's no single Hunt brothers position to target. There's no concentrated speculative actor driving the registered vault depletion. The vault is draining because of distributed physical demand from thousands of independent actors, all of whom have their own incentive to remove physical silver from the exchange system at current prices relative to what Shanghai is paying. A modern equivalent of Silver Rule 7 would have to target the entire long side of the market simultaneously, which would require position limit reductions that affect industrial buyers with legitimate procurement needs alongside any speculative positions. The political and commercial consequences of that action would be significantly larger than in 1980. The SEC and CFTC oversight environment is more complex. The foreign participation in COMEX is deeper. The global media's ability to report on any rule change in real time is incomparably greater than in 1980. And most critically, the physical demand driving the vault depletion is not speculative. It is industrial. You cannot write a rule that prevents solar manufacturers from needing silver for photovoltaic panels. The CFTC has a documented history of investigating silver market manipulation, and I want to be precise about what that record shows because it is directly relevant to understanding the institutional incentives at play today. In 2008, the CFTC opened a formal investigation into silver futures trading following complaints that the price was being suppressed by concentrated short positions held by a small number of large banks. That investigation ran for 5 years, was given significant resources, and was formally closed in September 2013 with a statement that the Division of Enforcement had found no viable basis to bring an enforcement action. The investigation examined whether large short positions held primarily at 2 major banks constituted manipulative price suppression. In 2020, J.P. Morgan's precious metals trading desk pleaded guilty to federal wire fraud and racketeering charges related to a decade-long scheme to manipulate the silver and gold futures markets. The specific behavior involved placing large spoof orders, which are orders submitted with the intent to cancel rather than fill in order to move prices in a direction that benefited the bank's existing positions before executing real trades, JP Morgan paid approximately $920 million in combined penalties. 3 precious metals traders received federal convictions. What the JP Morgan case confirmed with the weight of a federal guilty plea is that large institutional actors in the COMEX silver market did engage in deliberate price manipulation using spoofing techniques over an extended period. The case did not prove and did not allege a permanent structural suppression of the silver price at a specific level. What it confirmed was that daily and intraday manipulation was real, documented, and prosecuted. The distinction matters. Daily spoofing to move prices by a few dollars for intraday profit is different from a long-term strategy to keep silver below a specific dollar threshold for decades. Both involve institutional actors using market power to affect prices for their own benefit. One was confirmed and prosecuted. The other remains a thesis. What I can tell you with confidence, based on what is verifiable in the data today, is this. The registered vault is at 78,610,868 ounces. The May open interest is 384,740,000 ounces. Shanghai is paying a 16% premium over COMEX. The SLV borrow fee is 35 basis points. Every institution that holds a large short position in May, silver futures has a direct financial incentive today to prevent silver from establishing a confirmed floor above $90. Whether they act on that incentive through legitimate means, such as adding to short positions at 90 when their models say resistance exists there, or through illegitimate means like the spoofing documented in the JP Morgan case, the observable outcome is the same. Silver approaches 90 and gets pushed back. The mechanism is visible in the price action, even when the individual actors are not. What changes this dynamic is not a regulatory intervention or a policy shift. What changes it is the registered vault reaching a level where the cost of defending a specific price floor exceeds what any single institutional actor or group of actors can absorb. That level is not $90. It is probably not $95. The question is whether it is 100 or 110, or whether the COMEX exchange itself intervenes with a rule change before any of those price levels are reached. The data points toward the floor sequence described earlier, 90 held, then broken, then 95, then the 100 level as the next major battle. The timeline for those battles is approximately the 6 weeks from now through May 1st notice day. The registered vault at today's level of 78,610,168 ounces is approximately 32 million ounces below the level it needs to be to comfortably handle even a 10% delivery demand on May open interest. A 10% delivery May requires 38.5 million ounces. The registered vault after March delivery is complete will be approximately 70 to 75 million ounces. 10% delivery on May consumes roughly half the remaining registered vault in a single contract month. The exchange knows this. The large short holders know this. The institutional longs who have been patient through the February washout and the March consolidation know this. The battle at $90 is a preemptive defensive action to prevent the market from pricing, and what the math at May 1st notice day already shows. The inflow we saw today, small as it is actually the first evidence that the system is doing something other than simply draining. It suggests that at the current price level, some silver is finding its way back to COMEX. That is noteworthy. It also means that $85 is a price where some holders of physical silver outside the exchange system are willing to deposit and sell futures against their metal. That creates a soft support level around 83 to 85. Below 83, the Shanghai arbitrage economics become even more attractive than they already are, and the eastward flow accelerates rather than reversing. The inflow we saw today tells you that 85 is not a breakdown level. It is a consolidation level where the market is digesting the failed breakout attempt at 90, while the fundamental drivers continue accumulating pressure in the vault. The registered vault at 78,610,868 ounces is the number to watch. Every day that number drops is a day the May delivery math gets harder to solve. Every inflow day like today extends the timeline slightly, but does not change the direction. The battle being fought right now at $85 is not a battle about whether silver goes up or down this week. It is a battle about whether the paper market can contain the physical reality long enough to manage May without a public delivery crisis. Based on the vault trajectory, the open interest data, the Shanghai premium, and the historical precedent of what happens when institutional defensive positions meet arithmetic that no longer adds up, the data says the physical reality wins. The timeline is approximately 6 weeks. The sequence of floors is 90, then 95. Then the 100 level becomes the next contested resistance. That is the thesis. That is the data behind it. That is what this channel exists to provide. Now, I want to close with something that is not about silver numbers at all. This channel exists because there is a gap between what institutional analysts know about this market and what the average person following silver can access clearly and in one place. We do not ask you to trust us. We ask you to check every number we give you against the primary source, the CME Group depository reports, the CFTC commitment of traders filings, the LBMA vault data, the institutional analyst reports published by Goldman Sachs, Bank of America, and Citi. Everything on this channel is verifiable. If we get a number wrong, we correct it in the next video, and we note the correction explicitly. What you can do right now to be part of this community is specific. Subscribe so you receive notifications for every depository report analysis. Hit the like button on this video so the algorithm surfaces it to people searching for COMEX silver data, because those are the people who need this information most. Leave one word in the comments, bullish or confused. That single word tells me who is watching and whether the explanation is landing clearly. Share this video with one person in your network who owns physical silver or is considering it, because the gap between what they will read in the mainstream financial press and what the vault data actually shows is large enough to matter for their financial decisions. Silver AI Wealth is not a financial advisory service. It is not a newsletter. It is not a community selling you a membership to access information that should be public. Every vault number in every video is free on the CME Group website the same day we cover it. What we do is put those numbers in context, connect them to the institutional analyst data, and explain the mechanics that make them significant. That is what this channel has done since the beginning of this delivery cycle. That is what we will continue doing as May approaches and the numbers become impossible to ignore. I will see you in the next one.